A success in stock market investing is essentially the quality, depends on the quality of our decision making process. The more qualitative decisions we make, the better the overall success we are likely to achieve in the stock markets. And so the entire process is a function of making decisions from time to time, from day to day, on what to buy and what to sell, when to buy and also when to sell, in what sector to buy, and what sector or what stocks to avoid. So all these decisions here and there will give you an aggregate, overall success or maybe failure in our stock picking process. The entire episode, the entire matter boils down to the quality of the decisions we take as it relates to the investment process. And so decision making framework in stock investing, it helps investors to evaluate opportunities, reduce emotional biases, and make more consistent choice. It helps us to make more consistent choices. It helps us to reduce emotion when it comes to investing, and as well as give us that particular capacity to better evaluate opportunities we come across in the market. So all these factors are based on what? A function of our decision making. And so here are key framework for stock investing, key decision framework for stock investing. Number one here is discount cash flow model. Discount cash flow model. And so this particular model essentially estimates the value of a stock based on its future cash flow discounted to their present value. First of all, ascertain the overall cash that will come out of a given stock investment throughout its lifespan, let's say from now to eternity, and then discount that particular cash flow to the present time. That is what is called the discount cash flow model. It is useful for value investors, as comparing the discount cash flow model to the stock price, will help you identify whether the stock is undervalued or not, whether the stock is selling below its intrinsic value, or whether the stock is selling at a value considered as above its intrinsic value, whether the stock is overpriced. Number two is risk reward ratio. Risk reward ratio. So in this case, we compare potential returns to the inherent risk that will be undertaken to obtain that particular returns. So helping investors decide if a stock risk justifies its or if a stock's reward justify the risk taken. You ask yourself, the risk I'm taking in this particular stock, all right, does it actually justify the reward? Okay, that is what we need to consider. It's especially useful in growth or speculative investing. Usually, growth investing is could be somewhat risky compared to value investing. And so, once investment is considered speculative, that means the risk factor or the risk element is somewhat enormous. And so, you have to weigh it against the likely reward you are bound to obtain at the end of the day. Number three is Kelly criterion. Kelly criterion. A Kelly criterion determines the optimal investment size based on the investor's age in a stock, balancing, risk and reward. What essentially is the optimal size, of the investment you want to undertake based on your knowledge, based on your experience, based on your expertise, as it relates to the likely rewards you are going to get, not, not forgetting the risks it entails. Okay, and so generally it is used to maximize wealth while minimizing the chance of losing too much in any single investment. If you feel you are so knowledgeable as it relates to a given stock, you are highly knowledgeable, you understand the company, very, very well, and you feel you can do excellently or excessively well in that particular stock, you could put in a large amount of capital. That is what Kelly criteria is talking about. In a place where you fully understand an investment, then you can put in as much money as possible, because that knowledge and that experience will then help you to do what, perform very well, to have an overall excess returns in that particular from that particular investment. Number 4 is a modern portfolio theory. Modern portfolio theory. It focuses on diversification to maximize returns for a given level of risk. So advising that combining assets with low correlation, produces better results than individual investments. So this particular theory, emphasizes diversification. It states that it's better to diversify, mitigate your risk than putting all your eggs in one basket. And only that, if you diversify, it's a likelihood you would then, have a better result, a better return. You could create more wealth than focusing your entire investment on a single stock or a few, or a few stocks in the portfolio. And so the emphasis is diversification, risk mitigation, and then we hope all things being equal, you will then certainly get a better result while minimizing risk. Please then subscribe to this channel if you've not done that, and like this video, and give me a thumbs up, and don't forget to drop your comments in the comment section. Number 5 is an 80-20 rule, which is called the Pareto principle. In the 80-20 rule, the Pareto principle. This principle applies to almost all areas of human enterprise. It covers virtually all areas of human endeavor. It suggests that a small portion of the portfolio often drives the majority of return. Just a small portion of the portfolio will drive the majority of the returns you are going to get, you are going to get in the portfolio. It encourages investors to focus on high potential stocks and reduce attention on underperformers. Don't be surprised that just maybe 20% of the stock in your portfolio could give you 80% of the results you are going to generate. And so this particular principle encourages us to do what? To concentrate on just the top performers, the top 20 performers, of the stocks in our portfolio, because they are the ones that will eventually generate 80% of the overall result we will obtain at the end of the day. Number 6 is behavioral decision-making framework. Behavioral decision-making framework. And so this particular concept addresses the influence of psychological biases like loss aversion and overconfidence, helping investors avoid emotional decision-making and stick to data-driven strategy. When it comes to investing, as much as possible, let us keep emotions by the side. Emotions like fear, like greed, like going into panic mode, emotions like FOMO, fear of missing out, and emotions like maybe, like loss aversion. You are very fearful. You want to avoid loss at all costs. And we shouldn't forget the issue of overconfidence. Usually you can't invest without confidence, but you should avoid that that going the extreme, taking the extreme of becoming overconfident, it will not go well with us. It might lead to unreasonable losses in the portfolio if we become too overconfident in our skills, in stock picking. Number seven is top down versus bottom up approach. Top down versus bottom up approach. The top down approach starts with the macroeconomic factors and narrows down to sector and stocks. You generally, for the top down approach, you start with the country, you analyze its macroeconomic environment, and then from there you go down to the stock market, pick a particular sector that will benefit from the prevailing macroeconomic conditions, and then you now go down to individual stocks. That's the top down approach. All right. When it comes to the bottom up approach, the bottom up approach focuses on analyzing individual companies. you know Both can be used depending on market conditions. In the case of bottom up, you don't really, and you don't emphasize macroeconomic. You just go to the stock market, look at the securities involved there, and then you research based on what? Based on individual stocks. You ignore the prevailing macroeconomic circumstances in the country at that particular point in time. And so both of them are very good. It all depends on the market condition, and of course your preference as an investor. These frameworks enable systemic decision making, helping investors stay focused on long-term goals while minimizing emotional reaction. And so success in investment is a function of your decision making process. You make decisions there, what principles to apply, what stocks to buy, what sectors to invest in, and all other related principles as highlighted in this video. So once you can take all this into consideration, it will go a long way in enhancing your returns at the end of the day.